What goes into qualifying for a home loan? Well, there are a lot of variables that are considered when a lender is looking at a loan applicant. But one of the areas that is misunderstood that I'm going to chunk down today is debt to income ratio. And how it works is that from a lending perspective, the lender is going to determine what a borrower's gross income is, and that's usable income. And it's really important to know that what a lender looks at that meets the lending guidelines that's allowed to be considered as far as usable income could be different than what somebody is actually receiving in income. So just kind of know that that's a whole different video and a whole different topic. But for this purpose, we're going to assume a certain dollar amount for gross income. My goal is to kind of walk you through step by step and show you a few insights into how a debt ratio is actually calculated. So debt to income ratio is the topic today, and the abbreviation that you might hear lenders or real estate agents use is DTI. Okay, so let's dive in. So in this assumption, we're going to use a $500,000 purchase price on the home, and we're going to just assume it's a 20% down payment and the loan amount is $400,000. Now, in this scenario, we're going to also assume an interest rate on a 30-year fixed rate at 6.875%. See the note below with the APR and all that fun stuff. But for now, I really just want to kind of show you the metrics and how this equates and backs into a debt to income ratio. So in this scenario, this would mean that the principal and interest payment is $26.28 a month. So principal and interest, that's P&I, part of that PITI acronym that lenders use. PITI is principal, interest, taxes, and insurance. So that's what we're solving for here. So in this scenario, we're going to use $300 a month for property taxes, and then we're using $120 a month for homeowners insurance. Now, keep in mind, these are all going to vary. And again, they're going to vary based on the area that you're purchasing, the property type, homeowners insurance quote, again, can vastly vary depending on the area that you're buying. But for this purpose, this is what we're going to use. So this is going to give us what we're going to call a total PITI payment of $3,048 a month. And keep in mind, for this scenario, we're not using a homeowner association fee. But if you're buying in a community that has a homeowner association, it too would be calculated into this debt to income ratio. Now, a little bit more housekeeping before we move on. One, please know that I am assuming in this scenario that this loan would be submitted through the automated underwriting system that lenders use. And that's very important because if a lender is going to do a manual underwrite, the rules are different when it comes to debt to income ratio. So for this purpose, we're going to assume that this loan is sent through the automated underwriting system, which is a standard process that most lenders in our country use today when it comes to what we'll call agency home loans, which would include FHA, VA, Fannie Mae, and Freddie Mac conforming loans. That's the focus. Okay, and so loan type, again, that's going to kind of dictate what's allowed, but I'm going to kind of go just middle of the road here when we start to chunk down the numbers, so stay with me. And then I'm also just going to assume kind of a 740 credit score. Please note that the lending guidelines will dictate the credit score required. And some programs would allow for down to a 580 credit score. But remember, it's not just credit score that goes into this automated underwriting system. It's also the credit profile. So whatever else is driving that score, if there are late payments, if there's collections, if there's charge-offs, you might have a higher score. Let's say you have a 636. But the credit profile itself might put you in a position to not get a loan approval through the automated underwriting system. So it's not just kind of one and done, got the credit score, good to go. There's other things that go into that loan approval process. All right, so let's kind of move on. Page 2. Now, this is where we get into the meat. Remember, the PITI payment that we're using is $3,048 a month. I wanted to kind of show you a few different scenarios, though, and how we'll calculate this debt to income ratio that the automated underwriting system is going to read. Let's use gross income, gross usable income for the home loan at $10,000 a month. That makes it easy. And then think 45% of that's going to be the max debt to income ratio allowed. Now, see this big asterisk here? I'm asterixing for a reason. That asterisk is really important. And it's important because this automated underwriting system, it's in fact a system. It's a computer system and it's reading all the variables. And so there are some loan programs that would allow for a higher debt to income ratio, and some scenarios where maybe the loan program would allow for a higher debt to income ratio, but based on what's going on in the borrower's credit profile, income profile, etc., it may not approve that loan at a 45%. So I'm just using this kind of like middle of the road so you could understand how the numbers work. All right, backtracking. We've got $10,000 in gross income. At a 45% debt ratio, it would mean that the total debt could not exceed $4,500 in this scenario. All right. So remembering that the house payment is $3,048 a month for this scenario. And let's say scenario one, this borrower has $100 per month in credit card payments. Those are minimum payments that are coming through the credit report, and an $80 minimum payment per month on a student loan. And that would put our total dollar amount commitments, including this new house payment, at roughly $3,228 a month. So how we solve for the debt ratio is we're going to take that, divide it into the $10,000 gross usable income, and it's going to give us a 32.28% debt to income ratio. That is what's going to be calculated through the automated underwriting system. So, okay, let's go to scenario two. Scenario two is that same $100 a month minimum payment on the credit card bills, $80 on the student loans. But in this case, our borrower has a $300 a month car payment that is purchased, not leased. It's important to know if you have a lease, it's a whole different kind of thought process we have to get into. So purchased here. That's going to put our total monthly expenses at $3,528. Remember, part of that number is what will be our new house payment up here of $3,048 a month. So that brings the total debt obligation of $3,528. We're going to divide that back into our $10,000 gross income. That's going to give us a 35.28% debt to income ratio. So, okay, if the guidelines would allow for up to a 45% in our scenario, we're tracking along. Things are looking good. It's likely that that scenario could be approved through the automated underwriting system. Okay, get ready. Scenario number three. We now have a $1,000 minimum payment obligation on the credit card debt per month, $300 a month on that car payment, $80 a month on the student loans, and now we see a $200 a month installment minimum payment. We're starting to see a lot of these installment payments come up. I think that all of these online sources that we all shop with, they all make it really easy for us to take that payment and divide it into 4 or 6 or whatever it is. So just kind of know that those payments still get calculated into your debt to income ratio. So in this scenario, let's assume that that installment debt is now $200 a month. So now that puts our total monthly debt obligation at $4,628. Now, $4,628 per month divided back into our usable income in this scenario of $10,000 a month puts us at a 46.28% debt to income ratio. Well, if we make the assumption that the automated underwriting system in this scenario doesn't like or doesn't want to approve that loan more than a 45% debt ratio, then in this scenario, we may see a situation where that loan may not get approved. So again, it's one of these things that the debt to income ratio is a piece of the home loan approval process. It solely will not dictate whether the loan gets approved, but it's a part of what is considered, especially through these automated underwriting systems, but also in a manual underwrite scenario. Now, today I'm not going to talk about a front-end ratio and a back-end ratio and all that kind of stuff. I'm really just trying to streamline it so people can understand and I can kind of bust the myth about really what this whole DTI and debt ratio thing is all about. Other things that get included in a debt ratio are the student loans, which I showed, credit card payments, car payments, toys. So that could be an RV, motorcycle, side-by-side. All of those payments would get calculated in. Child support, alimony or separate maintenance, installment debt. I mean, any type of debt obligation that you've committed to gets calculated into that debt to income ratio. So it is important to think about when you're taking on new debt or even co-signing for somebody. This is really a big deal, especially with parents and student loans. If you're co-signing for a child on a student loan, then technically you're obligated on that debt. And if you're going through the home loan process, whether it's a refinance or a purchase, that debt will be reflected on your credit report. And then the lender is going to need to kind of back into an estimated payment, even though it's deferred. And even though you may share that with a child, you're still legally responsible for it. And therefore, that would be calculated into the debt to income ratio. Whew. That is a whole lot of something, right? I know. But if you have questions about this process, do not hesitate to reach out. You can click the link below to schedule a quick 15-minute consultation with one of the KellyZtilowGroup mortgage advisors, and we'd be happy to kind of walk through your scenario and help get you on the path to home ownership.